Do you want to invest like Warren Buffett? In this series of videos, you can learn how to evaluate investments using 10 golden rules drawn from Warren Buffett and a simple scoring system that I will show you to use to spot the best opportunities. Hello and welcome to We Have to Talk About Finance. I'm John Colley, and in today's video we're going to break down a 3-step scoring system based on Warren Buffett's 10 investment rules. This system will help you make smarter decisions and align your investments with the proven strategies that have built Buffett's wealth. Remember, this video is for educational purposes only and does not constitute financial advice. But if you're ready to learn how to invest like Warren Buffett, stick around. In the first video in this series, we established 10 golden rules for investing from Warren Buffett. And you can find this video here. Just click on the card that I'll put on the screen. In this video, video number 2, I'll introduce you to a scoring system that ranks the potential investments, scoring them either a 1, a 5 or a 10 so that you can easily evaluate them. I will also explain how to evaluate the final score out of 100. In the next and third video in this series, I will apply this system to real-world examples, showing you how Warren Buffett's strategies can work for you. I'll put a link to this at the end. Now make sure you stay until the end because I'll reveal a crucial insight that both Warren Buffett and Charlie Munger use to decide when a company is no longer worth investing in. This is important as Buffett says his preferred investment period is forever. Now let's crack on and look at how you score these 10 rules. The first rule is invest in business and not stocks. The scoring criteria evaluate how well you understand the business and its fundamentals rather than just focusing on short-term price movements. So if it's a 10, you thoroughly understand the business, its products, services, its industry position and long-term growth potential. You can confidently explain how it makes money and where it's headed. Give it a 5 if you have some understanding of the business but lack depth in certain areas. For instance, the competitive landscape or long-term risks. This means there's some speculation involved. This opportunity ranks as a 1 if you have little to no understanding of the business and you're purely investing based on market trends, news or hype. In rule number 2, we discussed the circle of competence, otherwise stick to what you know. This will assess how familiar you are with the industry and whether the business lies within your circle of competence. Give it a 10 if the business operates in an industry you understand deeply. You have knowledge of the business model, competitors and market dynamics. It's a 5 if you have some general knowledge of the industry and the business, but it's not an area you follow closely or understand fully. And it's a 1 if the industry and business are entirely outside your expertise. You're investing based on what you've heard from others or superficial information. And frankly, if that's the case, you shouldn't be investing, in my opinion. Rule number 3, look for a durable competitive advantage, or a moat. You're assessing the company's competitive edge and whether it can sustain that advantage over the long term. A 10 means the company has a clear and durable competitive advantage, such as a strong brand, network effects, or regulatory protection, that is difficult for competitors to overcome. It's a 5 if the company has some competitive advantage, but it's not fully clear how durable or sustainable it will be over time. And it's a 1, I'm afraid, if the company operates in a highly competitive industry with no obvious moat, making it vulnerable to disruption. Rule 4 is prioritising financial health. You need to review the company's balance sheet, cash flow, debt levels and overall financial stability. Give the company a 10 if it has a solid balance sheet with low debt, strong cash flow and consistently profitable operations. Its financial health is robust. A 5 means the company is financially stable but has higher debt levels or inconsistent earnings. It's not in immediate danger, but financial health could be better. A 1 means the company is highly leveraged, burning through cash or unprofitable. Financial health is a major concern. Rule number 5 is be patient and hold for the long term. Consider whether the business is something you would be comfortable holding for many years or decades. It's a 10 if the business has a sustainable and scalable model that is well positioned for long-term growth. You can imagine holding this investment for decades with confidence. A 5 means the business has short-term potential, but its long-term prospects are uncertain or dependent on market conditions. You may hold it for a few years, but not forever. A 1 means the business is speculative or has significant risks. It's a short-term trade and you wouldn't want to hold it for the long term due to concerns about sustainability. In Rule 6, we discussed price is what you pay, value is what you get. Here we need to evaluate whether the current stock price represents good value relative to the company's intrinsic worth. A 10 means the stock is significantly undervalued relative to its intrinsic value, offering a compelling buying opportunity. Key valuation metrics, price earnings, price to book, etc. show that it's a bargain. 5 means the stock is reasonably valued, but it's not a standout deal. You're paying a fair price for the company's value, but there's limited upside. And 1 means the stock is overpriced, trading well above intrinsic value with little justification. Buying at this level poses significant risks. Rule 7 is to embrace market volatility, and this scoring gauges your ability to handle short-term market fluctuations while staying focused on long-term value. A 10 means you're comfortable with volatility and view it as an opportunity to buy more when prices drop. You don't panic in downturns and have a strong conviction in the long-term prospects. 5 means you can tolerate some market volatility, but significant swings make you uneasy. You may not buy more during downturns, but you won't sell in a panic either. 1 means you are highly uncomfortable with volatility and prone to panic selling during downturns. Short-term price fluctuations dictate your decision-making. In Rule 8, we focus on the strong management in the business, and we evaluate the leadership team's track record, decision-making abilities, and integrity. A 10 means the management team has a proven track record of capital allocation, long-term value creation, and ethical leadership. They prioritise shareholders and think long-term. 5 means the management team is competent but lacks a strong history of proven success, or there are some concerns about their strategic decisions or transparency. A 1 means management is unproven, has a poor track record, or is overly focused on short-term gains. There may be some concerns about integrity or alignment with shareholders. Rule 9 is don't diversify too much. Here we assess whether you're investing with focus and high conviction or over-diversifying to the point of diluting returns. A 10 means you have a concentrated portfolio with a few high-quality, high-conviction investments. You're not over-diversified, but still adequately protected. A 5 means your portfolio is diversified, but you may hold too many positions, diluting your best ideas. You could stand to focus more. A 1 means your portfolio is either over-diversified to the point of becoming unmanageable, or it's too concentrated in speculative or high-risk investments. Finally, we come to Rule 10. Invest with a margin of safety. We need to consider whether there's significant margin of safety in the stock price to protect against mistakes or unforeseen risks. A 10 means you're buying well below intrinsic value, providing a significant cushion against risk. Even if the company faces challenges, you're protected by a large margin of safety. A 5 means the stock is reasonably priced with a modest margin of safety. There's some protection, but the price is closer to fair value than to a deep discount. 1 means there is no margin of safety. The stock is priced for perfection, and any small mistake or market disruption could lead to significant losses. So those are the 10 rules and how you score them. And what's interesting now is when you tally up the scores, what does it all mean? So here's how I would go about interpreting the scores. If you get a score between 80 and 100, then the investment aligns well with Buffett's principles and is likely to be a strong long-term holding if purchased at a reasonable price. A score of 60 to 79 means the investment has good potential, but further evaluation is needed, especially in areas like valuation and management quality. A score of 40 to 59 means that the investment may carry higher risks or be speculative. Careful consideration is required before investing. And anything below 40 means that the investment more than likely fails to meet Buffett's criteria and may not be suitable for long-term wealth creation. This scoring system will help you weigh different aspects of potential investments, making their decisions more systematic and aligned with principles of valued investing. Now, I promised at the beginning that I would give you a critical insight from Warren Buffett and Charlie Munger. Buffett has stated that if the competitive advantage of a company disappears, if he loses faith in the management team or the original analysis proves to be wrong, he sells. In the 1970s and 80s, Buffett held stakes in over 30 newspapers, as he believed their local United States city franchises made them impregnable. But the internet changed everything, and these moats dried up. Eventually, he sold all his newspaper holdings. Conversely, he's held Coca-Cola for decades. He once said that if he was offered $1 billion to create a competitor to Coca-Cola on a global scale, he would decline, as he did not believe it was possible to do this for practically any money. Be mindful when you're investing that nothing stays the same forever. So if you found this video valuable, make sure to like and subscribe to We Have to Talk About Finance so that you can stay updated with more investment insights. Don't forget to check out the next video where I'm going to discuss real-world examples using this methodology. The link is on the screen, so click and continue your journey to financial success. I will schedule the videos as premieres so that you can catch them when they drop if you're really early on and I'm still publishing this series. So thank you for watching this video, and I'll see you very shortly again in the next one.